Hello everyone. So in this video we're going to cover what is meant by cash management bills. So cash management bills are firstly a money market instrument. Now because cash management bills are a money market instrument, they will enable the central government to borrow for a short term duration of time and meet its borrowing requirements. The important thing to remember out here is that it is the central government which is allowed to use these cash management bills for meeting its borrowing requirements, and state governments cannot. So state governments are not allowed to issue or raise funds by issuing cash management bills, and it is the RBI which issues cash management bills on behalf of the government to enable the government to raise funds for a short term duration of time. Now in terms of structure, cash management bills are very similar to treasury bills. That is, RBI conducts auctions to issue these cash management bills. Also, these cash management bills in these auctions are issued at a discount and the investor gets the full value on maturity. So let's say a bank places a bid for rupees 97 for purchasing a cash management bill which has a full face value of rupees 100 on maturity, and that bid of a bank is accepted. So in this case, a bank is going to get a return of 3 rupees by investing in a cash management bill. Now the important thing to remember out here is that like your treasury bills, these cash management bills are also zero coupon securities, because what we witness out here is that an investor is buying a cash management bill at a discounted price of 97 and is getting the full value of 100 on maturity. That is, a cash management bill, like your regular treasury bill, is not paying any interest to the investor. The other very important thing to remember out here is that while structurally cash management bills are similar to treasury bills, but they have a duration of less than 91 days. That is, if the government wants to borrow for less than 91 days, it can use cash management bills, and if the government wants to borrow for more than 91 days, it can use treasury bills. So if the government wants to borrow for a very short duration of time, it can use cash management bills, and if it wants to borrow for more than 91 days, it can use treasury bills. Now similar to treasury bills, banks can use these cash management bills for meeting their SLR requirements. That is, in order to ensure that banks have a certain amount of liquid asset at a given point of time, banks need to maintain statutory liquidity ratio, and one of the forms in which banks can maintain these liquid assets is by investing in cash management bills. So cash management bills qualify for banks' SLR requirements. Secondly, if a bank wishes to borrow from RBI by using the repo facility, then a bank is again allowed to give these cash management bills as a form of collateral. The final thing in regards to cash management bills is that they are easily marketable, and by this we mean that because they are issued by the central government, they have very high level of credibility, and if an investor wishes, he can easily sell them in the market before their maturity. So this is all we wanted to cover in context of cash management bills. If you did like this video, do check out the next video in regards to ways and means advances. Thank you so much for watching.